for one thing, people have the assumption that when they make a deposit, that's their money, but it's not. When you make a deposit, legally, you are loaning your money to the bank. And in 1995, they enacted Regulation D, which legalized and enabled the banks to sweep your deposits into sub-accounts that are in the bank's name, and then use that as collateral for loans. And, frankly, most of the revenue that the banks generate right now is trading revenue, according to the Office of the Comptroller of the Currency. So that just enabled them to reduce their reserves and to use your money to gamble with. You don't even realize it because it's invisible.
Well, in the post-Dodd-Frank world, like you say, you're not simply a customer or depositor, you're actually legally classified as an unsecured creditor.
Exactly.
And legally, anyone that carries a balance over $250,000 by law can have the money directly taken from their account without permission to help the bank stay afloat if need be.
Correct.
Why should we be concerned, though, that that moment could happen sooner rather than later, that the banks may need to resort to this?
Well, number one, if most of their revenue is generated by trading and not by lending, and remember right now, central banks are raising interest rates to fight the inflation that they cause by their reckless money printing, right? Absolutely. And, and by the way, even though this says this is prop money, what are the ones that are issued by the governments? It's garbage.
Right.
Gold is real money, right? Everything else is just an imitation of it. But what we're seeing in the banking system is as they raise the interest rates, the system is falling apart because it's really been based upon a never-ending compounding of debt. And so the interest rates have been in a steady decline since the early 80s, and now they're anchored at zero. And central banks, when they tried to raise the rates in 2016, it was a big fat fail into 2019, wasn't it? They tried to raise the rates and then they couldn't. They dropped them all the way down. Now, with what they've done with interest rates, we've actually broken that, 40, 50-year trend line. That's significant. Anytime there is a pattern shift, you don't even have to understand what that means, right? But when there's a pattern shift, what that's telling you is that there is change afoot. And the bigger that pattern shift is, the greater the change that's coming.
Yeah. I've actually always wanted to have money rain down on me. Not quite like this, but, had to be more specific in my wish there. But fun and games aside, Lynette, this is very serious stuff. Because if you have over $250,000 in the bank can come and take it, and it's not an abstract concept. We saw that happen in Cyprus in 2013.
Well, what they did in Cyprus too. The first bail-in took everything. They ignored the deposit insurance scheme, which in the U.S. was put in 1933 to get people comfortable with making the deposit in the banks, right? So they actually enacted that, and at the same time, they separated investment risk-taking banks with deposit-taking banks. And then in 99, they eliminated that separation. So in 95, they enabled Reg D, which allowed them to sweep those funds underneath. And then just a few years later, they allowed the merger of risk-taking trading banks with deposit-taking banks. And now Wall Street really has full access to your deposits.
What would be the inflection point, though, that would make the banks need to do this?
Well, first of all,
how does that play out? Paint that picture for us.
Well, it is a crisis, and a crisis of confidence. So if you attempt to run on the banks, well, they're going to stop you cold. And if we go back to what was happening in 2008 and 2009, people were losing a lot of confidence because of that crisis, right? But I think that what's really interesting, using Cyprus as an example, because that's really where they tested it. Number one, you can see where the French and German banks had been investing a lot of money in Cyprus. And then all of a sudden, in 2011, they took that money out. And so it looks like this peak like that. But the average person, the saver, this is what they call sticky money. So in other words, you're going to make that deposit and you ask yourself, when was the last time you changed banks? You don't. So that's really what makes you vulnerable, because you have confidence in the bank. You have that relationship.